Hello guys, sorry guys, I didn't put an alert that there is like a live, but as usual it's always around 10 o'clock on Sunday. And for today's subject I choose trading versus investing, losses versus profits. Now this subject about losses and profits, trading versus investing, this is a very important subject for everyone, for traders, investors, either they are beginners, intermediate, or even professional. Sometimes you get confused about this kind of losses and profits when the subject is related to trading versus investing. Okay, so I will give you an example to understand what I am saying. Now, this is typically done for those who are beginners. Maybe you can, if you are a beginner. Hello Nasa, how are you? It's a long time I haven't seen you. So, this happens always when in general you don't know what you are doing. Are you doing trading or investing? So I will give you an example. Herman hello Herman. So let's say you have a trade according to your rules, to your strategy. You are searching for stocks, and then you find a stock today, and you think it will be going up as usual. Hello, Alex, Abdul. Hello, Alex. Now, you buy the stock. After a few days, one day or two, it go up or so, and then it go down. Okay? Now it goes down, and then you begin to see a small loss. Okay? 1 day, 2 days, 3 days. Now, what is the right way? What to do? Okay? You bought the stock, you think it's going up. It didn't go up according to what you think. It doesn't mean that your strategy is false. No, it's not that thing that I'm speaking about. There is no strategy that gives you a stock, whenever you buy a stock, it goes up. It doesn't exist. And if someone tells you it exists, tell him that he is a liar. even investors, and they lose business in choosing business. I will give you examples later. Okay? In general, what you should do, you should exit the trade. That is the normal thing you do. The trade doesn't work. You think that the stock is going up. Let's say you buy a stock at $20. $20 today. After 1 day, 2 days, 3 days, it begins to go down. Okay, 19.50, and then the other day it goes to 19. The third day it goes to 18. It means you begin to make a loss, and you get, especially for beginners who don't have this firm strategy techniques, what do? You get what we call a psychological weakness. Now, psychological weakness, what does it mean? It's not you say to yourself, no, I am not wrong. But you begin to become like stubborn with the market. The market tells you, okay, You bought the stock at $20. You think that the market is going down, that the market is going up. This is what you think. This is why you buy the stock. But the market say to you clearly, no, you are wrong. Now, what is the proof? Is your stock is going down. What is the other proof? It's a fact. You begin to lose money. It's a fact. You bought it at 20, now it is 18. What does it mean? You lost, okay? You lost $2. I think it's like 10% or something. So, what you should do? Normally, if you are a good trader, you have already before planned where to exit. If you are a good trader, if you are a responsible trader, if you know what is trading, you have already exit the trade, okay, at the stop loss that you have in mind. Either you put it physically or not, this is not important. What is important is you exit according to the plan. That's why we have what we call trading plan. A lot of people, they have never heard that there is a plan. Okay? It's like you, when you are going to a vacation, 1 week into vacation, and it's a touristic place. There are a lot of things you can do, you should see. And let's say it is overseas, it's another country, it's not your country, you don't know what is it, you don't know what are the good places to go, you don't know nothing about this. You just go and you just stay near the beach, you eat, you have fun, but you have no idea what to do. It means you have no plan. Even in fun, you should have a plan. For example, you have some places to visit, so you should devote each day. In the morning you visit something, in the afternoon you are at the beach, at night you should do something. It's like this. It means you fill your hours with something that you like. Okay? So it means you plan things. Not at the end of the last day of your trip. Okay? And then they give you or you find a booklet or touristic information. Oh, they say, oh, if you are here, you should see this and that and that and that. But it's the end. It's the dead end. It's the last day. So what you should do? You get confused. Which one to do? And even if you visit the place or you go, it's over. Because you have missed all the opportunities. Okay? Now, a trade, you should plan for it. It means before you buy the stock, you need to know where to exit if it goes wrong. This is planning. This has nothing to do with the stock itself. You do it with all stocks, regardless of what is the stock that you are doing. So this has nothing to do with the stock or with the stock market or with someone else or the broker or the stock market or the stocks or the weather. If it is raining outside or it is cloudy or it is sunny or there are thunderstorm, lightning, it has nothing to do with that. Or you have a problem with your wife or with a girlfriend or with your friends, or it has nothing to do with that. It is just a plan that you should do. You should plan before you do the thing. That's what we call trading plan. Casey said, does Warren Buffett still love Coca-Cola? I will answer you this question when we finish, because I'm going to speak about investment later. Okay? So I said that when we have a trade, you should have a trading plan. Trading plan makes easy for you. Why it makes? It means it takes this psychological burden. It means you know what to do at any situation. That's why you study strategies, you study trading plans, how to trade, the techniques. Why you study? Why you are learning all this? It's just to know what to do in the right place. It's not you are there and then you begin to think. This is not a good way to succeed in trading. To succeed in trading, you should have a clear strategy, clear exit with a stop loss or whatever. So you should have clear idea about this. Ref Buffman said, Karim, how are you? Very fine. I'm very fine. Thank you very much. Rochester 3, just buy QQQ and forget it for 10 years. Yes. This is buy QQ. You are like analysts that each morning they wake up, drink their coffee, and they say, oh, you should do this, you should do that, you should do that, you should succeed. Okay? So we don't do that. We don't just buy something and sleep. I will speak about investing later. Okay? So we go back to our question. Rahmatullah, hello Karim, hello. Guys, when you ask questions, you just put the questions. I will answer them later when I finish. It shouldn't be long today. I don't want to be having long live today because the subject is too. I know it is too big to think, but I want to simplify it. So we said the example again. You buy a stock at $20. You think it's going up. After a few days, it's going down. So what is the solution? What you should do? Now what you should do, you should have already planned it before. You should know where to exit before you buy the stock. This is what we call a trading plan. Now, if you don't have a trading plan for this stock, what will happen to you? Now, we have a psychological problem. It happens with you. And that's why people who trade with their real money, they face it. You face a problem, psychological problem. Now, if you do virtual trading, you don't care. You have, for example, you have a virtual account. You make tons of money, but your feelings, they don't go with these trades because you say to yourself, always you said to yourself, it's just fake. It's just fake. You lose all your money. And then when you say, oh, it's just fake. I didn't lose money because it is just fake. It's not real money. It's like you are playing a game where you play a game, you lose, but you lose no money. You just lose psychologically. Yes, it has an impact, but in real, you don't lose money, so it's not a big deal for you. Okay. Okay, so this is about trading. So when you make a plan, everything you do is calculated. And here, it's not only about stop loss. No, calculations, it has a big thing in trading and investing. Now, why calculation is very important? Okay? Why? The problem, because It's all about money. It's when you go to trading or investing, you are not going to love the investment, or you are going to put feelings in these investments or these stocks. They are not human to love, okay, or to care a lot. You care as business, as money, calculate. Okay, you buy it at 20, it's going to 18, and you decide to exit at 18. You lose 10%. That's it. You don't have to think a lot about it. You should go and do another trade. This is what we call trading. It means you buy. If things go good, you stay. If things go bad, you exit. That's, in general, the losses and the profits. Now, what if the stock is going up? Now, when it goes up, there is no limit. There is no time. There is no what we call price target, as some people they think. There is no. Because the stock can go few weeks, few days, like penny stocks, and a few days sometimes it goes so high and then it go down. So it can go few weeks, few months. Okay? Like last year when we bought at the end of March, so our stocks about 6-7 months, I begin to sell stocks because the trend, most of the trends has ended, and then the stocks begin to go down. So we sell. It's just because of the trend dries up. Now, so you see about trading, you try to cut the losses at the beginning if you are making losses, and don't make them very big losses. This is what happened with beginners. So let's explain. So, let's say this guy, or this trader, he buys a stock at 20. After 1 day, 2 days, it goes to 18. He doesn't want to exit. Now, ask yourself, why he doesn't want to exit the trade? What's the problem? Because this is a psychological burden. Because he's new, he doesn't know what to do. He thinks that he begins to have an idea that the stock will go up again. Now, if you ask him, who tells you that the stock will go up again? Who tells you? So he will never answer this question, because when you trade, there is no feelings about trading. Feelings, or you say, or you hope, or you come at night and you ask God that your stock tomorrow goes up, because you ask God, that's why tomorrow the stock will go up for you. Okay? So you go into this psychological problems, and this will cost you your money. And most of the beginners, if you are a beginner in the past, now if you are a good trader, you will see a big change. It's a big threat. If you buy a stock, it doesn't work, you should sell it. That's the right thing. You should have a specific price for to sell. If the stock comes back again in the future and it is so strong, you can buy it again. There is no problem. But what if the stock continues to go down? Instead of losing some percentage, whatever is this percentage, I'm not giving you a percentage because I don't I don't work with percentage. Okay? I don't work with percentage. So, if you continue holding the stock and the stock is going down, you begin to lose big percentage of your money. 5%, then you say 10%, 15%, 20%, 30%, and then you see a big loss. At that time, when you see 20%, 30% of this trade, it means your trade has gone so bad. This is a trade, this is not investment. Okay? And then, if you continue doing the same, and then you sell at the end, but with a big loss, then this money, and you take from your account other money, and then you do another trade, and then it happens the same, sometimes 2 times, 3 times, 4 times, it's over. If in each trade you lose 20% or 30%, for 5, 6, 10 trades, all your money is gone. And that's why most of the beginners, they have this problem of discipline. It is called in trading, this is called trading discipline. And I have made a lot of videos about it. Discipline, it means you are not disciplined. You have no plan. You are just going like this. And your fate is you become the biggest loser in the market. It means you just give your money to others. This is as simple as that. Okay? So you are not acting responsible for your money. You are not responsible. You come to the stock market, you want to make money, but you have big losses. It's not because the market is against you, it's just you are against yourself. Because you are not disciplined, because you don't have trading plan, because you don't know how to trade, and you have just a few ideas about trading, and you go to YouTube and you watch a person here say to you, you should do this. You go to another one, you say don't sell because when you sell stock you lose. If you don't sell, typically you don't lose. This is what someone has sent me. Always some people like this who are beginners, they send me the same email. Someone bought a stock at $100. Now it is $25. He lost 75% of his money. It's a big position. And I told him, he told me, what should I do? I say, why you don't sell before? He told me, oh, I think the stock will come back again. I say, who tells you that the stock will go back again? Who? How are you trading? And they say at the end, in order to give you an excuse for his loss, because all the beginners, they give an excuse. Oh, they say it's Wall Street guys. I was doing good in this stock, and then these guys who are called Wall Street sharks that I see in movies. Okay? This is the funny thing. I have seen the movie, that movie of the Wolf of Wall Street, and he short the stocks, and these guys are took my money. Okay, but I am fine. I am trading good. Sometimes I make money. But these guys, when they come, they took my money because they do short selling, and I lost my money. It's because of them. You see, when the beginners, they get rents against the stock market. Okay, they get rents against the stock market. It's just because they don't want to face the problem. They don't want to blame themselves for not doing good in the market because they don't know how to trade. They try to blame others. You blame someone, you blame the market, you blame Wolf of of Wall Street as people, they watch too much movies, okay? But you don't know these guys, what they do in their life. Selling short is normal. Everybody should sell short when you are day trader. You should sell short, because if the market is going down, the only way to make money is you sell short or you buy put options. That's the only thing you can do. Or you buy ETF, inverse ETFs. So you see that? Now, let's go to another another thing for the profits in trading. A lot of people they follow certain techniques that are false in swing trading. It could be good in day trading, but it is false in swing trading, which is price target. Price target is good in day trading, because the day you have a few hours, the stock cannot go that high percentage each day. It can go 2% a day, 5%, 10%, 1%. So it's not a big deal. But in swing trading, there is a trend that stays many weeks or many months, so you will never know where the stock will be in these few months. If you cut the profits, it means, let's say someone said to me, I have studied at someone, and he tells me, okay, when the trade you get 10% profits, exit the trade. Whatever is the trade, exit. It's enough for you. Now I ask him, this guy who has been taught by someone else. He told me he has a course, and we study and we do. I say, okay, let's assume, take all the stocks, check all the stocks that have a trend. Which stock has gone just 10% and stops? Show me how many stocks when there is a big trend in the market. Most of the trends make 70%, 100%, 200%. Now, if you take 10%, what does it mean? It means you exit where the party has just begun. It's like you. So I will just give you this idea. You have a party with your friends, you have not seen them, like for coronavirus, all last year, and now all the people are vaccinated. They say, okay, you should take this mask, and you can be close now. There is no distance, because when you get vaccinated, there is no problem with this virus. Okay? So you come to the party at 8 o'clock. You just enter, you see some friends. 8:15. Oh, he says, it's enough. I got some fun. I should go home. But the party is staying until 2 o'clock, 2 a.m. or 3 a.m. So you miss all the friends, you miss all the fun, you miss a lot of things. So that is the trend. The trend, look at it as a party. You should stay and hold when you are getting money, because you are getting more and more and more and more. Why you take 10% in the stock and then after a few months it goes 200%? Tesla last year it goes 900%. From $250 it goes to $2,200 before the split. Are you going to take 10% and the stock has gone 900%? Is this swing trading that you are doing? You will be the biggest loser, and you will never make money in the market. This is for sure. I assure you, if you do these bad techniques, you will never be a trader, and the losses are coming to you sooner or later. It's just because you don't know what's going on. You don't know how to trade, and your false ideas about the trading makes you lose. Even in a good trade, you lose. All your friends, they hold the stock for 6 months. They get 200%. And you take 10%. And then you go to another trade, you lose 10% or 5%. So what is the money? How can you make money? This is logical. So you are illogical in your calculations. And these bad techniques that you are using will affect your life as a trader. And that's why you begin to lose. There are some people, because they don't know how to trade, what will happen to them? They lose a big chunk of their money and then they stop. Oh, they say, no. I cannot be a trader. I am a bad trader at the end. But you see, when you are a bad trader, it doesn't mean you are bad. It's just you don't know how to trade. Now, this has a solution. You should just learn how to trade. And if you think that if you go by, just go by online and study from there and that guy, you will come up with a strategy and you make money. This is not true. Okay? In general, most of the people, it's not true, because each one, when he explains something, maybe it is for day trading and you think it's a swing trading, or you put it as investing. Okay? So this is all things about trading, about losses and profits. Now let's go to investing. Guys, I see your questions. Hello, Tolly. I will answer all your questions when I finish. Now, let's go to investing. Understand that trading and investing are totally different. It's another world. When you are an investor, it has nothing to do with the trading. Trading is in a short term, especially when you are doing swing trading. You are following only trends that are in the market. If there is no trend, there is no way you begin to enter and exit, and you lose all your money, because there is no trends. So you should follow the trends in order to make money. And this is how swing trading is good, is following the big moves of the market. Sectors that are going up, you should follow them. Find stocks in them. Okay? Now, let's go to investing right now. Now, when you invest, you are not looking for trends or for days or weeks. You are looking for fundamentals of the company itself. And you should ask your question. This company, does it stay like 10 years or 20 years in the future? Do you think it will stay? Do you think it will have other products that are competitive? Because the most important thing is competition. Understand that when you go to any industry, any sector, for example, if you go to banks, you find certain banks are doing better than other banks. Some banks become so big, having millions and millions of customers. Some other banks are very regional and they have only some thousands of customers, so they are small. Okay? Some banks can endure the time. It means when there are bad times, like in 2008, most of the banks have losses, big losses. Some they go bankrupt. So you should be only with the good companies, not with the weak companies. So when you invest, like Warren Buffett said, you should think about 20 years from now, because it is an investment. It is not investment. It means you believe in the company fundamentals, you believe in the competition of this company facing the other competition. And I see here one guy speaking about Coca-Cola, KC. I will speak later about Coca-Cola, but why Warren Buffett, when he bought Coca-Cola, he bought more and more shares? Why he doesn't sell when the stock goes down or the stock goes up, or for 20 years, 30, 60 years, 50 years? It means he bought Coca-Cola, I think in the 60s or 70s or even 50s. I don't know. I'm not exactly know the exact year. But he bought it when it was small. But he believed in the company. He believed in the product. When Coca-Cola comes, he believed that this company, okay, can endure time, can be a very big competitor, and it stays. That's why Coca-Cola is one of the biggest company drinks in the whole world. Coca-Cola, you find it everywhere, even in the natives of the Amazonia or Amazon. You can go there to Amazon. Let's say you are a tourist and then you go to the jungle. They tell you, oh, this jungle is a pure jungle. No one has come here. It's the mother land of humanity, for example. And then you find the plastic Coca-Cola, a bottle of Coca-Cola thrown there. It means some Indian has or some native people has already drank Coca-Cola. How can these people hiding into the rainy forest are drinking Coca-Cola? You see, it means Coca-Cola has reached these people. It means it is something that people like. The whole world, whenever you go, restaurants, you find Coca-Cola. Why you find it everywhere? You go to China, you find it. You go to Russia, you find it. Australia, the Amazon. Okay? Why you find it everywhere? Because it is strong. This company has strong fundamentals. And by the way, if you don't know, that the origin of Coca-Cola is here in North Carolina. Okay, at least you know that the origin is here. So this is why people invest. They invest in a successful company that endures time. This is what we call the test of the time. It means the company through 10 years, 20 years, 30 years, 50 years, 60 years, all your life, you see your investment growing. This is why the people, they invest in companies. It's not you invest in 1 month. This is not investment. This is trading. Or less than 1 year, 2 months or 6 months, you say, oh, I go to invest. No, this is not investment. Investment has to do with the company fundamentals, with competition, with other things. You should understand how the investment is, how to evaluate your investment, competition, and the other stuff. Does it stay after 5 years, 10 years, 20 years? Okay? So, if you are an investor, you should search deeply into companies and buy a solid company. When you throw your money there, you just wait 5 years, 10 years, 20 years. Now, the losses versus profits, if you stay 5 years, 10 years, 20 years, and you accumulate wealth, it means your investment is good. If you see the company was, let's say, capitalization. Let's say your company, now you see a company that it is small, it's not very big, Small company, like it's 500 million or 1 billion capitalization. It means the whole company is $1 billion, which is very small. In the stock market, it's small, it's not big. Now, if this 1 billion, after 5 years, it becomes 2 billion, 3 billion, 5 billion, 10 billion, what does it mean? It means your company is growing good. It means it is a good investment to stay in. Now, what if the company you think it is good, and after many years it was 100 billion, it was one big company, and you read the fundamentals, and you see some analysts, they say, oh, you should invest in this company because it is solid, it has 50 years in the market. Just buy because it has 50 years in the market, so it's good. Okay? So this is where the beginners investors, this is where they got lost. They got lost because someone else tells you what to buy. They shouldn't. If someone knows investing, he should teach you how to invest, not to choose for you. So you see the difference? It's not you say this guy knows better, so I rely on him. I say, okay, give me 10 companies that are good now. I invest in them, and after 10 years or 20 years, I become a millionaire or something like that. This is stupid. You should seek knowledge first, how to invest in companies. And then when you know, you begin to do your job and to search for companies, and you begin to make a portfolio. Okay? And after 5 years, 10 years, you begin to make money. And in general, investing, you will be making money. But if there is an investment that you begin to lose money, for example, it was $100 billion. After 5 years, 7 years, 10 years, after your investment, it becomes only 50 billion. It becomes 30 billion, 20 billion. What does it mean? It means this company is shrinking. It's not expanding as you might think. So it is shrinking. It means why it is shrinking? Why the price is going down? You can check, for example, Sears. All of you guys know Sears. It was for 60 or 70 years. It was there in the market. Now it exists. But now Sears is a stock that it is in over-the-counter stock. It's not even in the stock market. It's in over-the-counter stocks. Why? Because it lost business. It can't compete. If you go before, let's say Sears, it was the same as Target, the same. But Target stays in the stock market, and Sears lost almost all the business. Now they shut down hundreds or thousands of their stores. Why? Because they are not making any money. They are losing their way of doing business now because of competition. The customers flee because someone who is a customer, he goes to Sears, he doesn't find the good prices as he go to Target, for example, which is the same business. It means they sell the same, almost all the same thing. But you find that Target, for example, has done good, and this Sears has done bad, like JCPenney also. So when things go bad, you should evaluate after a few years. If it is a bad investment, you should just sell and buy another investment. It's better to stay 20 years and then you said that your company go bankrupt. And this is what happened, where the people, they will never see their investment. As someone said here, just buy this and leave it for 10 years or 20 years. No, you should not. Okay? You should not. Now, so this is in general what I want to say about trading versus investing, losses versus profits. And when we speak about profits, look, for example, at Warren Buffett. The profits he accumulated through 60 or 70 years of his life. It's so big profits all through years, because when he buys, he has a good choice. And even in his early age, he sold a lot of investments because they are bad. So even Warren Buffett is just a human. He do mistakes. When he bought Berkshire Hathaway, he has done the mistake. He said, 20 years I am holding into a loser, which is Berkshire Hathaway. It was only, at that time, it was textile company, having mills. But he thought as he was thinking that investing is just you buy and you hold. This is a big mistake. It's not you buy and you hold. You should see your investment after a few years where it is going. Okay? You should see if this company can compete. Because if you can't compete, you will lose business. When you lose business, everything will collapse and then you go bankrupt. And if you want to see companies that they go bankrupt last year, just put, for example, companies in USA that go bankrupt 2020. You will find hundreds of companies or thousands. Okay? Now, why they go bankrupt? Because they have no sales, they have no customers, or the customers become few. So the company should shut down because it can't just pay workers and they don't make no money or just little money. So they should sell everything and the company collapse and go bankrupt. Okay? This is in general, guys, about the subject of today. Now, let's go and check what you have written. So guys, now if you have some questions about profits and losses in trading or investing, or if you have something that it is confused, or you are confused, or there is confusion, please write what you have. Okay? Now let's begin. Hello everybody. Let's begin with Rochester 3. He said just buy QQQ and forget it for 10 years. Okay. First, Rochester 3. Please do not give recommendations in my channel. It means don't ask people what to buy. This is a bad thing you do. Now, QQQ is an ETF representing an index, the 100 stock in Nasdaq. Okay? So, an ETF takes a fee. It's not like stocks. And an ETF is always getting the average. Yes, for the long run, if the whole market is doing good, this ETF will be doing good, like Dow Jones, S&P 500, Russell 2000, the big indexes, and then we have small indexes. We have even small industry indexes. So ETFs are a lot and they are always emerging, because an ETF, it is like a small company. It takes a fee. An ETF, what does it do? It just follows an index. When there is an index, they put it they put, because you can't buy you can't buy you can't buy an index. So what they do is you buy the ETF. The ETF is like a company. It's like a fund. So you are going to pay a fee each year. It could be less than 1%. It's taken from the fund, from the price of the ETF. For example, let's say the ETF, let's say this QQQ, you make 10%. Okay? In the market, you make 10%. Understand that the company will take, let's say 1%. It will take from the price. So you don't see it how they took it, but they took it. So if you buy stocks, they don't take a fee. Okay? If you, for example, you buy Facebook, you let it 10 years, for example. No one, each year, the broker doesn't ask you to pay. Or the stock market, or they don't ask you to pay anything. So it's for free. So they hold it for you for free. And that's why investment, that's why Warren Buffett doesn't buy ETFs. Because ETFs, they have a fee. And you are not free to choose stocks. Because the stocks are companies, you can choose this company. But for example, this ETF, QQQ ETF, there are good companies, there are bad companies in this QQQ. So what does it mean? It means you are buying bad and good companies. Why you are buying bad companies? You see them, they are not doing well. You see some of the companies, you go to these companies, they don't make that much money. So why you buy the index? Because when you buy the index, you buy the average of a collection of stocks that are into an index. Okay? For example, if you take Dow Jones, we have 30 of the biggest companies in America. But some companies are doing good, some companies are not doing good, although they are big. It doesn't mean big, you are going to make money. Sometimes it's big, but it is losing money. So understand that. So the first thing I'm telling you is ETFs, there is a fee and there is an average, okay? An average thing, okay? So this is about your question. Rochester said, I love swing trading though, it's very good. Casey said, what do you think about the tech and biology in the near future? I don't think. You should see the chart and you should see where these indexes are going. So I don't think that much. I should see the chart. And as you might know, KC, you should, if you want to follow me for real, you should either check my training or you should be a subscriber to see what I think in the future, because this information is a paid information, because I will show you what are the industries and sectors are doing and where the money is going, because the money doesn't go everywhere. Now, why, when you say the money, which money are we speaking about? It's the money of mutual funds. Because who is moving the market in each direction? It's this big investment of mutual funds. A mutual fund, for example, he has $1 trillion. 1 trillion, it means, let's say this mutual fund has $1,000 billion. So he should choose some companies in the market. Now, when he chooses some, these companies will grow faster, and other mutual funds, that's why you should see some like in stocks going better than the other stocks. It's just because of this kind, what we call sector rotation or industry rotation. It means you find sometimes some sectors are doing good, other years you find that these sectors are doing bad. So nothing is the same every year. Every year, 2 years, there is a big change. So you should know this change and you should follow this change. There are techniques I showed to my subscribers how to see this change. Now this change is very, very important for everything. For investing, for trading, for everything. You should know where the money is. Because when the people begin to buy in the market, in general market, you can't see that clearly. But when you go to industries, you go to the sector indexes, then you begin to see that some are going up, some are going down. And thus, without fundamentals. It means you are not going to check each company what is going to do. No, this is just the prices. Because what moves the stock market is the prices, is money. Buying and selling, demand and supply, as they say. It's not because the company is doing well that the stock will follow. Sometimes the companies are making a lot of money, but their stock is not going up, like Walmart, for example. Check Walmart. Check Walmart last year and check Tesla in their chart. Tesla has gone from $250, nearly that price, $250, it goes to $2,200. It means 900%. Now go check Walmart. Let's say it goes 20% or 30%. Can you compare these two? No, you can't compare them. Tesla has done so good. Walmart, it hasn't. So, although they are big companies, but don't think because the company is making a lot of money in the world, it means as investor, you are going to make a lot of money. You are not going to make a lot of money if the price doesn't move that much. So, in order to make money, there are two things. Price appreciation, it means the stock should go up very good each year, and dividend. These are two things about investing. Now, let's go ahead. Rochester said, yes, YEC isn't going anywhere. I don't know, you are speaking about stock or something like that. Rochester, as long as the companies are growing revenue each year, the stock will follow in your investing. Sometimes it is not. Don't have assumptions. Go and check, for example, Walmart. They are making, it's one of the biggest companies in the world. They are making too much money. And they are growing year by year. And they are making more stores. It's a monster, Walmart. But the money they are making is for the owners of Walmart, shareholders, that they can make a lot of money. If you own 5 million or 10 million in Walmart, you can get dividend or you can go. So this, you can get a lot of money. But if you don't have that much money in Walmart, you are not going to have anything. Although Walmart, because Walmart, as any other company, they don't share their earnings, the true earnings, they don't share it with shareholders. Understand that. For example, you, in a 401k, let's say you work at Walmart, they have 401k. If they give you, when you participate in 401k, they give you some profits from the company. Yes, even though you don't have the stock, they give you profits because they give you the right, because you are a worker for them. But the dividend in the stock market, when you are just a investor, they don't give you that much, because they don't give you from the real money. They give you only from the stock. And this is the big difference, because a lot of people, they don't. That's why I have made a training about dividend stocks, because a lot of people, they don't understand even what does it mean, this dividend, and what does it mean profits of the company. They are always confused, and this confusion makes them think that the company gives money for free. It doesn't give the earnings for shareholders. Okay, so this is just something maybe you can follow and see. Okay, Fabian, hello Karim, hello Fabian, Tolly. Rarely are you the last buyer of something before a rally. Now, Tolly, what you are speaking about here is when to buy stocks. Okay? So we have techniques. Okay? There are techniques to know. And then when you buy, you just wait and see. If you are right, it's over. It means you are going to be in the trend and you are making money. But sometimes you can enter the trend at any time. Let's say, I will give you an example. Last year, from the end of March, we begin to buy stocks in our trade. Sorry for that. It stops, I think, for a moment. I think it's doing good right now. So, let's say if you take last year, at the end of March, we have the beginning of the big trend in the whole market. After the downtrend, 1 month downtrend. I have explained this all the time. Each week I will show you this. Now, how do you know that it is the beginning of the big trend? You should have techniques. But if the trend stays, for example, 6 months, you don't know that the trend will be 6 months. It's half of the year, from end of March until November or December. All the stocks, most of the stocks are going up, so you can make a lot of money. Okay? Now, you can enter to the second week, to 1 month, to second month. The stocks are always going up, so you can make money. You still can make money. So it depends, what are your techniques? If you have an excellent techniques, you begin from the first weeks. The first weeks you can begin. And the lucky ones, they can begin with the day one. Okay? So there are techniques to practice, and then you know. Because you follow the market too much. You should follow the market. You should have some techniques that spot the beginning of the trend. This is not a game for beginners. This you should know for real, how the market works, how the trends begin, how the trend ends. You should be a swing trader like us. Now this you need a training, or you need to follow. Like for me, I have subscription. You should follow me. I show you the things, and I will show you if it is true trend or not true trend. Okay? The Master Dad one said best stocks to buy this week. Now listen, there is no what we call best stocks to buy this week. There is best stocks daily. So for example, in my strategies, when you do the search, you find the stocks of today. that are ready to be bought, and the whole week, the whole year. So you should just buy and continue and sell, buy, sell, buy, sell until the end of the year, and in general you will be making money. Okay, so it's not by week or by month, but sometimes some occasions comes where you should buy in order to make a lot of money in the beginning of the trend. You should buy in the first week or second week or third week. You should buy at that time. But this needs, you should be following the market. Rochester said, that's why QQQ is good for 10 years. Okay, stop speaking about this QQQ. Okay, try to see, go to your chart, check in 10 years what this QQQ done and the other stocks. You will see that other stocks have done a lot, and understand that they take 1% or 25 or half point percent. This will be added to inflation. You are losing a lot of time, a lot of money each year. So now, if you are buying the top 10 companies in an ETF, now top 10 companies, how do you know they are top? You will never know. You will never know, because if you are a trader, swing trader like me or like us, you should follow individual stocks, individual companies, not because you follow, because the index has some companies that are fixed. For example, if you are following Dow Jones, you find 30 stocks that are fixed. They don't change them. So if you are buying 5 or 6 stocks from this, if they do good, but sometimes the stock is doing good, the other after 1 month, 2 is doing bad. It's go down. The other is going good. So it is not as you might think. And why you stop yourself from looking at other stocks? Why you are going to this 100 stocks and you choose from them? In the market we have thousands and thousands of stocks, companies. Why I should go to 100 stocks and buy always from them? What if these 100 are going down? 100 stocks belonging to whatever industry or sector, and they are going down. So why should I always be with them? You should be free. And you should not be focused on something, because this thing can go down and you lose all your money. Coco Jumbo, he said, hello from Seattle. How are you? Thank you very much for coming. Nasa said, he said, VIAC lost half of his value last week. So yes, Nasa, sometimes when there is the earnings, it is too bad where the short sellers, they short sell the company because of the bad news. No, when this comes, the company loses a lot of value, half or more. Sometimes I see some companies, they lose 90% of the company, especially with those drug companies where, for example, the FDA refused their drug or their thing, so the company collapsed because in the future they don't sell this drug or this thing, so they have a big problem. It happens. Yes, thank you very much, Nasa. Casey said, E-Trade has restricted my account. Now, restricted accounts is, for example, when you do a lot of day trading and you are not allowed to do a lot of trading. You don't have, for example, $25,000 in your account. So when it is just cash and you begin to do a lot of trades, your account will be restricted for some months until you change your strategy, because they give you why. So when you contact them, so you say here, I called them many times and uploaded the documents that they requested, and they start bitching around. The only reason because I traded GME. So, but restriction, yes, in GME, it was a big manipulation. That's why, like Robinhood, like a lot of they restrict trading in this stock because they get scared. They get scared about the SEC, Security Exchange Commission, because they were looking if this is manipulation in the market. If there is manipulation and they know who is manipulating, they can have a very bad thing. Like individuals or like brokers who play with the stocks, okay? They are right to do that because they get scared. Okay? So if there is restriction, or you want to trade more this GME, you can find other brokers, and you change some of your money there if they don't restrict people. Okay? Other brokers. So you can have two brokers, for example, two brokers. One broker is big, a full service big broker. They don't usually, people, they are investors, they don't trade that much. But if you are with a broker that most of the people, like Robinhood, most of the people, they are not investors, they are traders. They trade a lot, they see the news, here, buy this, sell this, buy this, sell this. So the people, they play a lot. So that's why they do restrictions. And I have seen that some brokers at that time, they have restrictions. And I have made a video, a 55 minutes video about GME, GameStop. And I show you the manipulation. Okay, there is a big manipulation of this, guys. So, Guy, Casey, if you are still trading this, you should either choose another broker and put some money there. When they, for example, they restrict you, you go and you buy from other broker, because it's not the market. Understand? Here is the deal. It's not the exchange that has stopped GME or other stocks. There is another stock also at that time. It's not the stock market. It means the exchange. It is the broker who stopped trading in his platform. But the stock is traded in the stock market. In other brokers, they still trade. They buy, they sell. Who cares about GME or another stock? It is just because GME, it was a buzz in the stock market news, and it was in the big news in the Wall Street, and we say, what's this, what's that, why GME, why it goes up, why it goes down. So we have a lot of stories. That's why a lot of people, they get interested. So Russians say they charge 0.20. Yes. Well, what I tell you is that this ETF check compare it to a stock for 10 years, how much you gain. Try to find other good stocks in the market. Try to see how much they gain and see which one is the best. Most of the time, stocks are better than ETFs. Most of the time. Not all, but most of the time. If you are lucky, when you are lucky sometimes, but it's not always. You said, well, they increase in dividend. Dividend is taken from the price of the stock. It is not from the money of the... I have explained this, so you should understand. If you don't understand, you should go to my training level 16. How to invest in dividend stocks. I explained a lot of things about the dividend, about kinds of dividend, about a lot of stuff that you should learn. It's not as easy as you might think. Okay? Rochester said Walmart is more a dividend stock, not much of a growth stock, but over time it goes up. Now try this growth and value stock. It's just a vague information. It's not any stock that it is giving dividend. It's called value, like Walmart, and it is not growth. Sometimes you find both. You find a stock that gives dividend and it has growth. Now you say to me, oh, give me an example. I give you an example. Apple, for example. Apple, it was 100 last time, just last year. Let's say it goes to $500. Now from 500, they split into 4 and the share becomes 124. So you see, Apple is a growth stock and it is a dividend stock. But Walmart is not growing. Yes, it's not a growth. It's just a value. And you should have a lot of money. So why the people, they put their money there? Sometimes the old guys. Because they don't care that much. Because they have a lot of money, so they want a stable investment. Because why the people, they choose, for example, Walmart, and they don't choose other stocks? Because Walmart is stable. It means each year it goes 5%, 10%, 20%, sometimes less. Sometimes it loses 10%, 20%. But the people, they get dividend from all their money. So let's say someone who has $1 million. $1 million, he put it in Walmart. Let's say Walmart gives 5%. Just an example, okay? Now, how much you get a year? You get $50,000. Some people who are old, who are 65 or 70, he doesn't care about growth, about stocks that fly like Tesla or some big investment that goes up too much, go down, because he's scared. Some old people, they are scared, and all the retirement specialists, they say, oh no, don't go to these stocks, they are volatile. If you put, for example, $1 million in Tesla, you can 1 year you can get down, like it goes down, for example, 60%. So from 1 million, at the end of the year you will have 400,000 only. So you lost 60% of your money. So the old guys, they are scared to lose all their money because these stocks are flying. Sometimes they go up too much. Sometimes they go down too much. So they can't bear this movement of the stocks. That's why the old people and the retirement specialists, they say to you, okay, you are old, so your account should not be volatile. It should be going steadily, just little by little. This is what they advise. Because if you put it for Tesla, sometimes it's going up, sometimes it's going down. And they can have heart attack if they see they put $1 million, all their investment, all their life retirement is $1 million. Let's say someone who has accumulated 1 million, which is not that big deal, but for some people it's too much money. Okay? And you put it in Tesla, and 1 year it goes 60 or 70% down. Now he has $1 million, then he sees 300,000. He can have a heart attack and he can die because of this. That's why the specialists in retirement, they say, okay, don't make too much money into this kind of stocks. You should just put little bit if you want, but most of the people, they don't. They put it in banks, in insurance, in other stocks that things that doesn't move that much. Okay, so you should understand this. Juan Carlos, he say, hi Juan Carlos. Elia Palavan, hey sir, how to find multi-bagger stock? I don't understand what do you mean by multi-bagger stock. I have no idea what is it. So you should just explain more. I don't understand what you mean. Karim today, hello Karim. How is EV market? Is it good for long-term investment? So listen, long investment, as I have explained before, you should need to see companies. You should see the fundamentals. So it's a lot of work. It's not just you go like this and you buy anything and you say it's a long investment, it's very good. Okay? So you should deal with companies. This is what I say about this. If the top 10 companies go down like Apple, Microsoft or Tesla, the Nasdaq goes down because of the weighting in the index has in this company. Yes, thank you very much. I know this. So last year Nasdaq went up 69.89 because the companies did well. Yes, but you are saying 69.89 in index. But did you see Tesla how much it goes? It goes 900%. Are you going to get 69 or 70%, or do you want to get 900%? We are traders. We are not following indexes. You can invest in indexes because they go slow. Okay? They go slower than the market. That's why a lot of people, they don't go with ETFs. Sometimes ETFs do good, but you find always the stocks that are doing better than ETFs. This is what I am trying to explain. Now, if you like ETFs, you want to invest in them, it's your problem. You do whatever good for you. But you are not doing trading. You are doing investing in ETFs, in indexes. Some people, they do. You get the average of the market. You don't do bad, you don't do good, you do the average. It's okay. Now, KC, they block, you can even transfer your money. No, I don't think so. I don't think that E-Trade or another broker block your money. They can't. So when you sell, for example, you have GME. You sell it. After 3 days, the settlement of your money, you can take money to your bank or outside. No, because if they block you from using your money, they should have a court paper. They should have a court paper. It means they have something against you. But the broker cannot be against you. Except when there is something wrong and they tell you that all your account is freezed for 3 months or 2 months. You should go and ask them the legality of this, because this is not, I think it's not legal. Yes, if they stop you from GME or from other stocks, or to buy and to sell because they think GME was a big problem in the market, yes, they can stop you from trading 3 months. For example, they say, okay, you don't trade. Yes, I don't trade, but I can take my money and close the account. They can tell you, no, don't close your account. It's my account. They are not free to do that, because when you sell, your money is in their account, in your account. So you just transfer it to your bank account, not to another broker. Don't do that. But just to your the money that it is settled after 3 days, the matter will settle. For example, you sell GME. You have, for example, $10,000. You settle down, so your money is in your account. They restrict you from trading, but they can't restrict you from taking your money from your account. If they do, you should ask them to send you an official document, because they stop you from using your money, and this is not. Now, if they restrict you from trading, yes, they can do that. They can. But your money, in order to withdraw your money from your account, they can't. I guess. I'm not sure 100%, but you should ask them. Ask them. They should release your money. You say, okay, you don't let me trade, I'm going to another broker, so stop your account. I don't care about what you do, but give me my money back. Because if they freeze your money, it means they have something against you. Now, when they have something against you, you should contact a manager, and he will explain to you the situation. Because no one will stop your money except when there is a big thing related to a suspicious activity or something like that. So you should talk to a manager and see the thing. But I think they don't block your money. I don't think one. Casey, Melvin Capital Bank bankrupt because of GME. I have no idea. I don't follow investment and which is bankrupt and why. So I don't follow this. I have no idea about it, and I don't know why it's doing this. B. Torres said, AMC is the stock you are referring to, Kareem. Oh, yes. GME and AMC, those two stocks, they have manipulation, a big manipulation, and there is a lot of trouble in the market. That's why Robinhood has blocked all the trading for these stocks. There are other brokers, they stop because they see that it goes to Wall Street, to the news, and the brokers, they are scared that the Security Exchange Commission, they ask them, why do you let these people play with these companies? So in order to avoid the problems, because they can lose a lot of money or they get fined or something like that, you know that they are subject to fines when they do mistakes, because brokers sometimes they do mistakes, and when they do mistakes, so the Security Exchange Commission, they punish them by fines or by stopping their business. So it's billions of dollars. So they try to always to comply with the rules of the Security Exchange Commission. Okay. Casey said there is no manipulation because the short squeeze and the hedge fund which was short. Ah, man. Listen, Casey. I have put a video of 55 minutes explaining the manipulation, and you told me there is no manipulation. You don't know what is it. So Casey, if you don't know what is manipulation, you should watch my video. Okay? You should watch my video to understand what's this manipulation. Don't say short sellers are everywhere. Every day short sellers, they are selling short, they are traders. The manipulation happens when these Reddit guys, they ask 2 million people to buy what is it, GME, because GME is going to bankruptcy. It's a bad company. It's losing business for years, and they want to help the company. You can't help the company when it is losing money. If the company wants to go bankrupt, it will in few years because they lose business. Okay? So please, Casey, I have made a video I think last month. Please check GameStop video. Put GameStop in my channel, and then watch the video, please. You will find a lot of details what did happen. Because you don't know what did happen. That's why you think it's not manipulation. Manipulation happens every day in penny stocks. Because they can't manipulate because the stocks are small. If you have a lot of people and they go to a stock, they manipulate it. Okay? Because it is thin and we have a lot of people. It's not normal trading. A normal trading, there is only news that makes the stock move too much up or down, like earning news, like a gap up or gap down. This is not manipulation, because this is because of the news. The people, they short it or they go long. That's why you have a gap up or a gap down. But if you go to GME, it's not earning news. It's not GME has made a lot of money and then the stock from 19, it goes to $400 because GME has been making money. Or the earning news. No, it's the opposite. GME is losing business. Okay? Now, B. Torres said, excited to watch that one. Yes, guys, if you want to understand what did happen exactly, I give just a broad thing. I give you events, what did happen. So when you follow the events, you follow the stock and how it moves. I showed you with the chart, I showed you where is the manipulation. Where is the guys who are Wall Street, they short it. Why it goes up. Wall Street, they can play. It's not they short it. These people are not playing in the market. They are Wall Street. When they hit a stock, it's over for this stock. Some stocks I see them, they are $100. Next day it is $10. They hit it because of bad news or something. So don't. This is not manipulation. This is news. Okay. Rochester, individual stocks far outperforms ETFs. Yes. You say individual stocks far out performs ETF most of the time. Yes. Because the ETFs gives you the average. It is an index. It's the average of the bad and good stocks in an index. That's why Warren Buffett doesn't buy ETFs. If you are an investor and you buy an ETF, you are wrong. Do like Warren Buffett. He is the best example in the whole world. he has never bought ETFs. Because he knows ETFs, they are just the average. He doesn't want the average. He wants the best companies in the market. He wants the best. He doesn't want the average or the bad and mix all this. Warren Buffett doesn't choose for example, losing business. Do you think has Warren Buffett bought, for example, GME? Did he buy GME, for example? No. Now why? It's an old company and it was doing good in the past. But this company is doing bad for many years. That's why people, they flee from this company, because it might go bankrupt, out of business sooner or later. I don't know. Unless you are messing with 2x leverage ETFs, but this is too risky. Rochester, listen, Rochester, please, you are having a subject that we are not speaking about today. We are not speaking about ETFs. We are speaking about, in general, about investing and trading losses and profits. So we are not speaking about ETFs directly, because if you are going to just speak about ETFs, we will change the subject. I don't want to change the subject of this video. I have spoken about these ETFs in other live, so you can check them. You can ask your questions. Yes, I would like 900 gain, but year over year it's not sustainable. It will take 60-year investing instead. But 60% in 2008, you will be losing 50% of your stocks, of your so you will lose it all. Okay, so it will be a bad thing. But don't you think that some brokers are colluding with big guys? No, they are not. Brokers are here to take your money, because they live from you. They live from you. Okay? It means you are a customer in their platform. They are the middleman. When you buy, they take some money. When you sell, they take some money. This is their job. Their job is to link you to the exchange. They have no other job than that. So they take some money in order to live, because it is a business. And they pay money to the exchange. So understand that they are paying money to link you to the exchange. For example, you are staying in your home. You go to the platform. Let's say I want to buy Apple. You just go to Apple, buy 100 shares. Okay, it's easy. But you don't think that they allow you, because they have a link to the exchange. That's why you will be able to buy. So they pay some money for that service. So you should pay. But you pay little money compared to them. They pay a big money. Casey, but the market isn't logical in many cases. Yes, the market. Why you want the market logical? Okay? Why you want the market is logical and the people who trade are illogical? Can you understand that? The market will not be logical because the people are not logical. They are not. That's why you find a lot of people, they don't know even what they are doing. They invest in any company, they trade any stock, they don't know any rules of trading, of planning the trade, of strategies, technique. They don't know nothing. They just buy. Someone tells you, oh, buy this, you buy. Someone tells you, oh, it's bad stock, sell, you sell. Another guy tells you here, oh, do this investment. In 10 years you will make money. But you buy 10 years and you lose all your money. Okay? So these are illogical people. They are not logical. That's why the market is not logical. So you understand the relation? Hope so. Robinhood did with Citadel. They allow Citadel to track Robinhood traders' activities. But this Citadel, when they give them information, for what reason? What does this Citadel do? I don't know this company because I don't follow this company's thing. Casey, we are talking about GME case. Yes. Okay. This is very true. I used to do many illogical trades until I found your program. Thank you very much, BTORS. It's just, you know, what it takes to be a good trader or good investor is just to understand the basics. It doesn't mean you should be the biggest trader in USA. No, it's just you understand the techniques, you understand how to plan the trade, how to invest. When you have this basic thing, you can be a good when you practice. That's the deal. Okay? No one is born knowing everything. So anyone can do mistakes. When you begin trading, you begin to do mistakes because you don't know. And you think it is like this. What you do is good. As someone said to me, if you don't sell, you don't lose. Okay? And when his company go bankrupt, I say you lose it all. You don't just lose 10% or 5%. You lose it all. Some people, they can stay because the CEO and the analyst, they lie about the company. They say, oh, the stock is going down too much, but rest assured that we are making plans. Next year, the stock will go up and we make profit. But this year, we lose money. Now, who tells you that the company is making a file to file for bankruptcy? Because when they file for bankruptcy, they tell no one. But when it is done, the stock is already taken from the exchange. There is no stock at all. You wake up, you don't find your company in the broker. As some people, they send me emails. They said to me, okay, one day I open my account, I have some investment, I don't find one stock, and I call the broker, where's my money, where's my stock? They say, oh, you don't know? What? It's bankrupt. Because he doesn't know investing, he doesn't see for many years his investment, where it goes, if it is a good or bad investment. That's it. Okay? So guys, we are at the end of this session. Thank you very much. You have asked a lot of questions and it is a good live. And guys, if you have no... yes, it is bitters. It is painful, yes. And some people, they trade a stock, they lose money and they stay in it until they lose a lot of money. This is also big losers, big traders. As we have big traders, we have big investors, losers also. It happened to Warren Buffett at the beginning. I give you this example. You can check it online if you want to. And Warren Buffett spoke about this mistake. 20 years and he was investing all his money into Berkshire Hathaway, and it was just textile company about mills. And then after 20 years, he understood that he has done the biggest mistake in his life. And he bought gas stations also. You know, gas stations. And then he sold them all. Why? Because he lost a lot of money. And then Berkshire Hathaway, when he buys banks, Coca-Cola, insurance like Geico, and then his account become bigger and bigger and bigger and bigger. And that's why now he is one of the best investors in the world. He understood the lesson. Warren Buffett is like anybody else. He just study and he begin to practice, and he find that most of what the people say is wrong. Okay? And he gets some knowledge about this guy who wrote this book, Graham thing. I don't know what's I forgot the name. The investing, the intelligent investor or something like that. And he studied it, and then he finds that he was mistaken. If you, for example, if you have a company, and each year, after 1 year, you lose business, you should do something. Either you sell the business and you buy another business, or you start a new business, or you should change your business and you see why it is losing money. This is the best thing you do. It's not just you waited until no customer comes and then you shut the doors and that's it. Welcome Juan Carlos. Rochester said Buffett lost billions in airlines, 4.2 billion. Yes, he can listen, he can lose 4 billion. But he has made, let's say last year, let's say he made 50 billion. Now 50 billion, take 4 billion in a loss in one company or two. This is not a big deal. He is still making money, and this is the most important thing in investing, is the whole portfolio will be making you money and dividend for the whole life. This is the best thing. And when there is something bad, you can sell it. When it is a bad investment, you can sell it at any time and buy another investment. Okay? So losses are normal in investing and in investing. But when you say 4 billion, you should check the whole account, how much he has. If he has 300 billion and he lost 4 billion, it's only 1%. It's not a big deal. It's not like you, when you buy a company and you buy only one company, you stay 10 years and then you lose 50% or 60% of your money because the company collapsed. Okay? So you should understand that he is aware of investing, about the companies, and he follow them, and he has guys who are always searching for problems in the companies in order to exit sooner. He doesn't want to stay with a loser, okay, until he go bankrupt. Okay guys, thank you very much for watching this live. I enjoyed it. Some people have written a lot of questions, especially Rochester 3, who is obsessed with this ETFs and Q. Okay, thank you very much, and hope next week we can have another topic. As each week, I want to change the topics. If you have guys other topics you want to talk about, just send me an email and we can talk about this. Thank you very much, and see you next week.